Hello, everyone. This is Omar Khan. I'm the founder of Boardwalk Wealth. And if you've been living in a cave all these last few months, you kind of forgot what's going on in the world. But if you read the news, you're seeing the same thing that's been going on back and forth every day for the past 8 or so weeks. Oil's past $100 a barrel. Treasury yields are spiking. Bond markets are in turmoil. And geopolitical pressures and tensions are reshaping markets, financial, oil and gas, commodities pretty much overnight. So if you're an apartment investor or aspiring to be one, you're thinking to yourself, what does this have to do with any of my investment or what I plan on doing? And well, the short answer is it's got everything to do with your apartment investment. The world literally sets the price of your apartment. That's what this webinar is about. Welcome, Miles.
Thank you, sir. Thank you. Glad to be here. This is Miles. I'm the Director of Sales and Acquisitions with Boardwalk Wealth. So some quick context for first-time viewers. This is our monthly investor webinar. Previously, we chatted through broken capital stacks way back in January. The second topic that we did was the loan is as important as the property. And then last month, we did honest failure points. Each of these reframed a concept for investor understanding. But today, as Omar mentioned, we are chatting through how the world sets the price of your apartment and would argue this is the most consequential webinar we've done yet. So as of April 2026, investors are dealing with three overlapping crises. And I want to name them specifically because lumping them together as uncertainty is frankly useless. Crisis number one is energy. Geopolitical tensions between regional adversaries in the Middle East have resulted in the Strait of Hormuz being functionally closed. I'm sure all of us are aware. The strait handles 20% of the world's daily oil transit, and oil shot past $100 a barrel for the first time in 4 years. Crude jumped 12% in a single week and continues to exhibit extreme volatility. If closure is prolonged, and analysts project $150 to $200 per barrel, which is absolutely brutal. So why do I mention all of this? What does this matter in the world of apartment investing? Well, oil is the building block of our economy. It's not just a commodity. Every dollar increase in oil flows through construction costs, transportation costs, energy and utility costs, and consumer budgets. Very, very relevant points. The IEA, International Energy Agency, called this the largest supply disruption in the history of the global oil market. The Dallas Fed modeled the impact, saying that their estimate for crude average would be $100 per barrel this quarter, second quarter, and GDP growth impact would be minus 2.9 percentage points.
Well, as I'm dealing with a personal crisis of my own, I'm recovering from a sickness. The real crisis that's afflicting the world, not me. The second crisis that we should talk about is a trade war crisis, or rather the after effect of the trade war crisis and how it's affecting us. So there's been much consternation about the role of tariffs, retaliatory tariffs. Where are things going? And I'm looking down over here because I've got a bunch of stats. So the average tariff rates now across all imports are 12%, but the average tariffs on steel, aluminum, and copper are 50%. Yes, 50. These are core structural materials that go into pretty much every multifamily or apartment development. And this cost increase doesn't necessarily just get all absorbed by developers. It eventually, over a period of time, either gets translated into higher rent. So this means your housing affordability continues to get worse, or projects stop penciling altogether, which means the supply of affordable quality housing then goes down because projects are just not financed anymore. And the third crisis, which is basically it's not geopolitical, it's not trade related. Rather, it is what's happening inside the financial system as a result of crisis one and two. As a result of crisis one and two, what's happening is lenders are pulling back from construction financing. Now, what this means is that when less financing is done, less potential supply in the future is on the horizon. What this also means is that as interest rates and yields are spiking, bridge loan maturities that were working through the system those sales, forced or otherwise, are now accelerating into distressed assets. As an example, special servicing rate hit 11.1% in February of this year, which is the second highest number since the great financial crisis. Those loans that were underwritten in 2021, 2022, floating rate loans, well, on a lot of properties, the NOI doesn't even cover interest payments. That's the conundrum. Sponsors are contributing or trying to contribute more equity just to keep the loans current. So, three crises, three inputs into the same equation: geopolitical tensions, which leads to energy prices spiking, which leads to consumer and all other construction costs going up, tariff related pressures on cost, and then financial related issues. So each one of these independently constrains supply, but together they are decimating the pipeline. And let me walk you through how this rate picture now fits into this little segment that we have.
Thanks, Omar. Thanks. So just before we go on, so the bond market made an interesting statement over the past month. Can you walk us through what happened and what it means
Yeah,
for apartment investors? I think this
again,
relates to your rate chain reaction.
yeah, look, again, got a bunch of statistics that we had to update because there has been so much volatility. Excuse me for this. So just around February 2020, February 27 of this year, 10-year rates. Now, why are 10-year rates important? This is the benchmark rates across which real estate gets priced off of. Real estate is a long-term, potentially holding asset. This is a 10-year benchmark rate that gets real estate priced off of. That was 3.97%. In mid-April, this hovered to around, went all the way up to 4.44% and then settled around 4.32%. Now, what does this mean? This means that volatility, which used to be single digits in any week, it'll go up, it'll go down, is now metastasizing. And it's more over like 30, 40 bips moves. These are huge moves. They don't seem like big moves, but in the context of the most liquid market in the world, these are phenomenally huge volatile moves, which is leading to the market basically giving us a statement. The statement, and I'm going to use the famed economist, ex-head of PIMCO, Mohammed El-Arian. I'm going to use his framework. His framework is very simple. It's saying the bond market now is worried more about inflation as a result of oil prices going up, tariffs coming into the picture, than it is about growth. Because the issue we've had in the last few years is, hey, the economy seems to be walking on a tight balance. You know, if you take out AI as an example, last year and all the money that went into that, we basically had flat or negative growth in the biggest, greatest economy on the planet. So the market right now is saying, hey, earlier we had a growth issue, or rather the fear of growth not happening. Forget about that. We actually feel the specter of inflation is upon us. And think about it this way. Normally, when geopolitics escalates, you know, there's a war somewhere, or some big thing has happened, money starts flooding into treasuries. Why does it flood into treasuries? Because this is the safest instrument on the planet, bar none. As money floods into it, there is a finite amount of supply, but a lot of demand for this. What this means is that the price of bonds go up, and bond and interest rate prices have an inverse relationship. As the prices of bonds go up, this means the yields go down. Right. Now, what's happening is, typically what would happen is yields would go down, prices of bonds would go up, but the exact opposite has happened. The market has looked at oil, it's looked at tariffs, it's looked at all of these other concerns and said, we feel this is inflationary. Compensate me for taking this risk. So something extraordinary has happened that's never happened before, frankly. And to give again some context over here, sponsors who are underwrote to 2021, 2022 floating rate loans in this little era, well, those with that type of debt are trapped, because the issue fundamentally is that they have a broken financial structure, a broken capital stack. Because fundamentally, at its very core, apartments are continuing to function as they should. Residents, by and large, pay this. There is no secular lack of demand for housing. In fact, if anything, housing affordability is such a problem that there is more and more demand. Right? This is unlike the office sector, where there is a fundamental question on whether the demand or supply of this asset, how much should there be? But what's broken right now is the debt structure. The loan structure is broken. The previous owners, in many cases, have lost all of their equity. And in Texas, especially, where I live, for instance, Texas has been the darling market of apartments. Well, things are even worse than the national average. Miles, why don't you walk people through what does this mean for their portfolio?
Omar, are you allowed to speak poorly about Texas? I thought you were in
I
Texas
mean,
and I don't know if this is allowed. Are you on Texas soil right now?
I am on Texas soil. The bigger question is how long am I allowed to stay on Texas soil
That's right.
after?
That's right. We need to make sure that this is edited appropriately. So let me translate what Omar just walked through into what it means if you're sitting on capital and evaluating a multifamily investment right now. As Omar mentioned, let's first dive into Texas. This is where the most aggressive bridge lending happened in 21 and 22. And there's some staggering stats that I want to go through with you right now, and this is mostly vacancy related. So, average vacancy in San Antonio right now, 15.7%. Austin, 14%. Houston, 12.7. DFW, 12.4. Typical concessions, 6 to 8 weeks rent free. And in some of the aggressive submarkets, you're looking at 10 to 12 weeks free, which is absolutely ludicrous. And all these stats exceed the national average. So, again, just as you heard, San Antonio is now the most vacant major multifamily market in the country at 15% vacancy. And that's not a demand problem. That's the tail end of a supply wave meeting a capital structure problem. So what should investors be filtering for right now? And I want to walk these through slowly just so you capture them. So number one, is the sponsor's basis when you're evaluating low enough that debt service works at today's rates, not at projected rates, at today's rates? Number two, is the asset on fixed rate agency debt or is it floating rate bridge? Number three, does the deal only work with rate cuts? If yes, surely walk away. And number four, is the operator acquiring assets through lender relationships where the real distress deal flows or through the open market? All of these things are good filter tools when evaluating deals. The dividing line, as Omar just mentioned, and we've continued to reiterate, is the loan structure. Sponsors on fixed rate agency debt are operating normally. Sponsors who relied on floating rate debt, bridge debt, are the ones in distress, and there's this polarity happening. We covered this again in the February webinar, and the last 6 weeks have made that case even more clear. So Omar is going to walk you through the supply side now, which is where the opportunity thesis really comes together. Omar, please go ahead.
Thank you, Miles. So everything and there's a whole bunch of stats. That's where you might see me looking down. Everything we've discussed right now, geopolitical tensions, energy, tariffs, credit freeze, this is creating collateral damage in the construction pipeline. And this is the thesis segment. So some facts over here. Construction costs, just the input prices alone, January to February 2026 annualized are up 12.6% just in 1 year. Now, total import values since early 2020, right? These are up 43%. But here's the kicker. Fabricated structural materials since 2020, same time period, are up 63%. These are items that you cannot choose to not use. You can't substitute them. These costs are materially up. And it's not like, as an example, rents are up 63%, or conversely, interest rates are down 63%. If anything, interest rates might be more than up 63%, and incomes haven't kept pace. So housing affordability continues to be a big problem. Now, we need an additional 500,000 more workers in the construction industry. That's nowhere to be found right now. This is why 94% of contractors are reporting difficulty in just filling positions, basic positions, not nobody's trying to be a nuclear scientist here.
So Omar, let me get this right. Material costs are at a historic high. There's labor shortages. Then you add the tariff layer on the structural materials, and finally, the tour de resistance. The credit environment is drying up construction financing. So what is the result of all of this lumped in together?
Well, it's pretty stark and frankly unprecedented. In fact, construction starts have declined close to 40%, a little bit over 40% since their peak in 2022. Permitting has declined close to 38% from its peak. Multifamily permits just in January 2026, month over month, by the way, December 2025 to January 2026, they're down 12.4%. And check this out, 16 major markets in the US, the greatest economy in the world, the greatest country in the world, 16 major US markets have 0 units under construction. And I can assure you, it's not like housing affordability has been solved in those 16 markets. If anything, this lack of supply is exacerbating housing affordability. To give you some context, over the past 12 months, developers have completed and delivered close to 223,000 more units than they are starting. The scale of this is unprecedented in its magnitude. Annual deliveries, which were 500,000 units in 2024, are expected to be about 300,000 in 2027.
Wow.
So you have to understand, when we connect it to our portfolio, or just an apartment owner or aspiring investor's portfolio, the supply cliff is the single most important tailwind. Yes, in a way, if you own assets, this is a net positive because this is a math problem. Demand is not going away because housing affordability continues to be a problem. This is a problem across the country now. It used to be in California or New York, maybe say some parts of the coast. It's everywhere now, even in the great state of Texas, which was very affordable, right? Now, the gap between mortgage payments and rent payments right now, nationwide, again, these are huge variances depending on where you live, but the average is between 1,100 and 1,200. This means mortgage, actually owning the house, costs you more than renting by $1,100 to $1,200 a month, not over the year, a month. So the structural demand, the demand for quality, affordable housing, this is running headlong into a lack of supply. So rent growth from here on and out, this is arithmetic. This is a mathematical possibility, not just a possibility. It is happening versus just some marketing from some broker or some other third party. To give you some context now, because there is such a lack of, or not a lack, there is such an amount of oversupply in the Class A space. Class A rents, even with all of this oversupply, nationwide are flat. But Class B rents, even in this current market, are up 1.7%. In our value add portfolio, the rents are up 5.8%. Right? What does this tell you? This tells you that the recovery is already happening in the asset classes where we operate, which are multifamily, and within specific sectors of multifamily. The headline data is just lagging right now because of the oversupply of Class A units.
Omar, do you know which major metros that have just completely stalled and frozen deliveries? Do you have any offhand?
A lot, yeah. A lot of these are basically in the southeast, but surprisingly, some of these are in metros on the coast as well, especially California, the Illinois, New York, where it's not because where people don't want housing. It is all the red tape, it is all the interest cost, all of these things are death by 1,000 cuts that are now hitting everyone at the same time.
That's
exactly.
Right.
And you know what's ironic basically is that the supply pipeline is being destroyed by the same forces that are creating distressed deal flow. It's very ironic. These things are now related to each other. These are not two separate stories. There are two sides to the same coin. So I can tell you what we've done to take advantage of this situation. What we've done is that we've restructured 12 distressed deals from lower to middle market sponsors in the last 2 years. We've inserted ourselves between the borrowers and the lenders. This is close to 2,000 units. And the discounts to peak market valuation are 25 to 40%. These are huge discounts. Now, why is this happening? There are three big reasons here. Number one, we have a solid operating platform. This allows us to take over distressed assets, first of all, for cents on the dollar, and then quickly transition them and solve all of their problems within months versus years. What is a typical operator doing? Secondly, You have to marry your real estate knowledge with extreme financial sophistication, which is what we do. Because gone are the days where you could just be a great real estate operator and things would work out. No, you have to understand, like we do, what levers to pull on your loan agreements, how to manage your cash flows, how to do all of this stuff while you are managing a very big burgeoning real estate portfolio. So combining real estate expertise with extreme financial sophistication. And lastly, the icing on the cake is surety of closing. In today's market, especially, lenders are prioritizing working with people, groups like Boardwalk Wealth, that provide surety of closing. This is the most valuable currency right now. And just to give you some context, if right now you hear any syndicator, any sponsor telling you that they are sourcing distressed assets on the market via brokers, listing services, and the like, I can assure you I'm in this line of work, they are lying to you. All of the action is not with brokers, not with listing services. All of the action is with the lenders. Lenders control the note because the equity is all wiped out, and the lenders are now scrambling to try to figure out what's going on. Nobody is paying market. Anybody that's paying market right now needs to get their head examined. This is stupid. All the action is with the lenders. Lenders want to deal with groups that have the capital, capability, and the track record.
Right. So this question has come up often. It's on my mind. What if things get worse? Rates go higher. Why wouldn't someone just want to wait this out?
So that's a good question. We view all of these items, go, no go, what to do, what not to do, from a mathematical point of view. We buy at or below loan balances. First of all, you have to understand the loan balance right off the top is anywhere from like 25, 30% all the way to 40% or below what the purchase price was. So we're buying at or below that value. So right off the top, we have a lot of equity built in. Then we're transitioning it to our operations platform. So we already know, okay, here are the three list of things that are operating. And you have to understand the reason why we can say this is, A, we've got a track record, 12 distressed assets, 2,000 plus units, 5 states in the last 2 years. But also, this is an asset class where fundamentally demand continues to rise. It is not a supply issue. It's not a demand issue. It is merely sourcing the right assets at the right valuation. Now, when we acquire these assets, we look at it from the perspective of how much below market are we acquiring, but also can we refinance into agency debt? The reason why this perspective is very important, and by the way, we've discussed the value of agency debt in an earlier webinar as well. The reason why this is important is because ideally we want to recycle our capital as quickly as possible. So we want to buy below market, fix the problems, quickly sell it, and make money. In the off chance it takes a little bit longer than that's going to happen, we always have the possibility of refinancing to agency debt, which is the cheapest form of capital. But this form of capital is not available to all the sponsors. It's only available to the most sophisticated sponsors right now. We are one of them. We are repeat agency borrowers. This access to the cheapest capital in the market allows us to have so much optionality that otherwise people cannot have. This is why having this ability is very important. And lastly, I want to point out it's not like the government or anyone is doing a favor by having these agency mandates. One of the mandates of the agencies is to provide a financing market for clean, quality, affordable housing. This is why they're very strict on their perimeters. You need to have a stabilized asset. Everything's got to be clean. The sponsorship's got to be clean. The assets got to be clean. But to give you some context, the agency's cap this year for lending is $88 billion. And this is up from $73 billion last year. So this is telling you the government is screaming and telling you that they want to lend, but they want to lend to only the best quality operators with the most stabilized assets.
That's right. I didn't know that our names could be beside the word sophisticated, Omar, to be honest, but I'm glad
Now,
we've just written that in the stars. I love that. Okay, so let's pull all of this together. Again, there's three crises, one thesis. Number one, energy tensions drive oil and construction costs. Number two, tariffs compound material costs on steel, aluminum, copper. And number three, the credit freeze chokes new construction and existing loan workouts. The result of all of this, as we've outlined, is that starts are down 40%. The completion gap is now at 220,000 units, and value add rents are up 5.38%, one of the few asset classes. And institutional capital is at 165 billion in 2025 volume. That's the summary of this webinar. If you want to talk about how this applies to your situation or how Boardwalk is positioned, we're always available. If you haven't reached out to me, my email is miles@boardwalkwealth.com. Omar's is similar, omar@boardwalkwealth.com, and we would love to connect.
Look, I'll just close with the famous Jay-Z line: men lie, women lie, numbers don't. We basically showed you the number. To do with them is up to you. Miles, why don't we open this up for some questions, please?
Yeah, that's right. Let's do it. There's already been a couple coming in, but please just use your question chat window to submit more as they come to mind. So, Omar, we're hearing about 6 to 8 weeks free rent in Texas, 10 to 12 in some. How do you reconcile that with the recovery thesis?
Well, this is actually, this is not a, first of all, it's not a demand problem. There is a mass, I mentioned, there is a mass amount of oversupply on the Class A space, and that is fast getting absorbed. So demand is ample. In fact, absorption, which is fancy word for demand, that is at record highs. This absorption is fast taking over all of the supply. Value add assets, by the way, in a lot of these markets are not offering comparable concessions. So that still tells you that the customer is price sensitive, and at various price points, the customer responds differently. So we feel this is a self-correcting mechanism because we've already felt that when more supply hits, there is ample demand to absorb it. So if anything, it's a temporary phenomena. And those groups that are getting in right now, like us, they are actually acquiring assets below replacement cost. So we feel it's part of recovery, but at the end of the day, everything is based on what price you buy something at. And we feel investors that are coming in right now are they're really making their dollar work for them.
This might tie in with the second question. Couldn't waiting 6 to 12 months just give even better pricing? Ties into what you just chatted about.
Well, yes and no. The reason why it may or may not work is because our thesis is based on basis, like what is the price of something. Think about it this way: it's a bit like if you go to buy a car in the market and that car's market price that it sells for is $50,000, but due to a temporary issue, it could be whatever the issue is, that car is now being offered for $30,000, and you, by the way, happen to be in the market for the same car. Would you acquire something at a significant 25 to 40% discount right now, or hold off in the hope that you might get a bigger deal in the future or better deal in the future? The way we look at it is when you're acquiring at 25 to 40% off peak value, you don't need future declines in interest rates to help you with asset valuations. You are getting an asset at a fair valuation, very accretive terms, by the way, at terms which the borrower and the lender are begging you to take over. So you can really drive terms. You can really extract all last juice out of it. Nobody can time the bottom. When you get a good deal in a good market with fair financing, you need to go for it.
What if tensions expand beyond the current conflict?
Well, number one, that's a that's a question above my payroll. I'm not the president of the United States, so these are questions far above our payroll. What we feel is, in fact, if anything, if tensions exacerbate, then what currently the market is telling us is when initially the conditions exacerbated, yields spiked up. So right now, if you're acquiring assets and conditions exacerbate, well, your assets now have even more value because you are able to lock in cheaper financing than somebody 6 months from now can lock in. So you're in a much better position. And again, at its very core, I'd like to point out this is only because affordable housing continues to be a challenge across the board. This used to be in a California and New York thing. It's across the board. It's even in places like Texas and Georgia. Yeah. So if you're able to acquire assets on the cheap with low cost of financing at accretive terms, get them, because if things go worse, you're actually in a much better spot to begin with.
Omar, there's lots of talk of multifamily investments where distributions are paused or they've gotten capital call notices. How do you evaluate recoverable versus terminal?
Look, that's a tough. It's a tough but interesting question. First of all, what I always tell people is, you are in many ways you are investing with the sponsor. You're betting on the jockey, not the horse. Number one. So kind of do your due diligence there, but also realize, okay, from a jockey point of view, what are their reasons for doing this? Because there's a lot of operators right now that are in over their skis. There, some of these are very big operators, by the way. They have huge companies, they have huge payrolls, they didn't really necessarily streamline their operations. And what they're basically trying to do is cash themselves out of their deals at the cost of investors. So kind of keep those qualitative aspects in mind. But on a deal level basis, look at whether, look, this is a loan, is it a floating rate or a fixed rate loan? When a sponsor is giving you an idea, hey, we need more capital to do X, okay, but what does that mean? Is it merely an extension for a year, which I feel is a very short period of time? Right. Or are they saying, hey, like what we did, we are going to refinance into agency debt. Now we've got 5 or 7 years, which then allows the sponsor in a market to actively fulfill all of their business plan, right? What is their current DSCR? Is this a foreclosure process? Because look, you might throw good money after bad. If it's just a 1-year extension, I can assure you things are not going to improve in 1 year. Right? So you got to start looking at it from a high level point of view, but understand why a sponsor is doing it. And if they can't give you a clear answer, if they're cashing themselves out at the expense of you, then that's a more dicey situation. And I've seen a lot of those happen recently.
I have one more question here. We encourage, again, anyone else who has a question, please chime in. But if the bond market is pricing a possible rate increase, should investors worry about cap rate expansion?
So sorry, say this again, please.
If the bond market is pricing a possible rate increase, should investors worry about cap rate expansion?
First of all, investors should always be worried about a cap rate expansion. This is why buying at a solid basis with a significant discount to replacement cost, there is no replacement for that. You also then have to do analysis on seeing, okay, what markets are you in? Are you in markets that are secularly growing in the long term, places like, say, Dallas? Or are you in markets that might be declining, parts of Pacific Northwest and parts of Northeast, which, by the way, right now are doing pretty well? So that's a perspective that's on a case-by-case, asset-by-asset, and market-by-market basis, as opposed to a generalized idea of, hey, go do X and Y will happen. But should investors be concerned about cap rate expansion? Yes. But a lot of times this boils down to the sponsors, to the transaction, and to the market that they're investing in.
Great. Well, Omar, that was the remainder of our questions. Again, we open it up for anybody who wants to reach out to us privately. We're always happy to have conversations more about this topic or other topics that are on your mind. Omar, any parting words?
No parting words. Again, that Jay-Z line, men lie, women lie, numbers don't. Please be fully aware of what's going on. Only invest with the highest quality sponsors. And a lot of times what I read is on all these capital calls is sponsors trying to cash themselves out. Remember, at the end of the day, your counterparties are human as well. They have the same set of incentive mechanisms that anyone else has. And it is your duty as an investor to understand what those incentive mechanisms are, and then take your investments in that regard. But remember, there are very many honest people doing the right thing. In fact, the vast majority of people in our industry are doing the right thing. Sometimes things are at a trough, and sometimes things are at a peak. We need to dollar cost average and take a long-term view of our investments.
Perfect. Well, thank you everybody for joining. Again, looking forward to future conversations and our webinar next month. Thanks, Omar.
Thank you. Bye for now.
Bye.